Hello everyone, welcome to my channel. I am Atanu Sood, your trusted guide in financial safety and investment. As a certified mutual fund distributor and insurance advisor at Policybazaar with a wealth of experience as an ex-financial consultant at HDFC Life and 2 decades of service in the Indian Air Force, I have dedicated my life to securing and growing your wealth. Currently pursuing CFP, I am here to share insights that can transform your financial journey. Let's dive into the exciting world of money safety versus risk and discover how to build a secure and prosperous future. So, everyone, you should aware of how better you can manage your most preferred asset, that is your money. In this session, we are going to discuss what I want. I want safety. Equity is very risky, and that's why I prefer bank FD. Equity means share market. So equity market is risky, isn't it? I want safety, and my bank FD is giving me 7.5% guaranteed. Why should I invest in equity? Now let's start a journey and see how the prospect it is. Let's start with an exemplary journey you will never want to miss it. And it is for everyone. Everyone should know this. So let's start. Starting from RBI data, bank deposit stood at rupees 200 lakh crore at the end of each calendar year 2023. This is not a small amount, and that's why this data shows every one of us is investing in bank FD. Why not? Since it is safer than any other asset. But it is not so. Let's start a new journey. At first, we remember a golden rule, that is safety first, by our great investor Warren Buffett, one of the richest person in the world. What he was said, the first rule of an investment is don't lose money. And the second rule of an investment is don't forget the first rule. So, as per his vision, we should take the safety first, right? Next, we should start journey. Now, what is the definition of safety? What the definition of safety of the money versus safety of the value of the money? What we can save? Are we saving money? So, definition of safety means what is the safest way to safeguard your money? Will you keep all your money into the locker like a bank empty? What happens? Is it the true way to safeguard our most eligible asset, most secured asset? Let's say an invisible thing which no one can see but everyone can feel. It is rupee safe is not rupee safe. How it is? The value of rupees 100 over a period of time, assuming average inflation of 7.59%, is nowadays value is only just rupees 3. It is due to the inflation risk. Inflation erodes the purchase power of your money every year, and it is invisible. So, if anyone puts his 100 rupees in his bank locker and forgets it in 1979, and in 2024, if he opens the locker and bring back that 100 rupees, originally the 100 rupee value of that day becomes rupees 3 only. Now, this is the inflation. This is a devaluation of money. No one can see it, but everyone will feel it. Now, we are presenting some inflation data. Now, what is the historical inflation? The devaluation of money, how fast it is devaluating. From the year 1979, we are collecting this data, and if we are considering this value, the value varies from 3% to 13%, and the average of all the inflation data that we have taken is 7.59% per annum. That means if you are keeping your 100 rupees this year, and if you want to spend the same money to the next year, you will only get the valuation of rupees 92. Where is rupees 8 gone? Because the 8 rupees has gone due to inflation risk, and this is the inflation which erodes money over time. So, our example, let's see another example of an restaurant bill. It is of the year of 1985. A simple vegetarian plate costing rupees 23 rupees 30 pesos. How much will the same menu cost today? It is costing 1369 rupees this year. It may be 100 200 rupees difference, but not more than that. So where we are, so past and present, the valuation of money is decreasing in such a way you cannot imagine how your money or your kept money is devaluated. So your inflation, that is the price inflation and lifestyle inflation. These two types of inflation daily basis on the daily basis it erodes. So we are earning how much we are earning, but due to this inflation, price inflation and lifestyle inflation, our expenditure is going up and up and up. And you can see the amount whatever you have is not enough to actually beat the price inflation and lifestyle inflation. So take the look how it is affecting our income journey. If the inflation is on the upper hand, let's say 14.40, that cannot be ignored because already we have a such circumstances when there is a 13% inflation. So 14.4%, if the inflation rises, then we, if the total monthly expense of the today will be get doubled every 5 years. That means every 5 years you need to have earned double of your money as of today. If it is 12%, which is more likely as of now, because whatever the government data is showing is, is total average inflation. But whatever the price, whatever the equipments or whatever lifestyle changes affects us is more likely to near about 12%. And if that happens, if your total monthly income today is 100, then in 6 years you need to make it double, because you have to beat the inflation. If it is 10.23, which is very less likely, then your total monthly expense amount get doubled in every 7 years. So what is the way? There is a way out. We have to think about. So what is the FD? Whatever I have put in my bank, what it is giving? Today's expense is 50,000. If I put my FD interest for 10 years at 7.5%, then what happens? The value of the FD will be 1,03,052 rupees, and the inflation is in 10 years is 2 lakh rupees. So, are you getting my point? Are you seeing this? What happens to your money? Because you have not invested, because you have not put such instruments that can overcome the inflation. It is like the ostrich effect. Now, the ostrich effect is also known as the ostrich problem. It is a cognitive bias that describes how people often avoid negative information, including feedback that could help them monitor their goal progress. Instead of dealing with the situation, we bury our heads in the sand like ostriches in the ostrich effect. Now let's say what Sensex or in equity market, if I am invested in 1979 when the Sensex was formed, it is at the point of 100, and if we have put money on that 1 lakh rupees invested at that time, what is the value of today? As on March, if the Sensex is 73,651, though now it is much more than that, what will be? The value would have been 7 crore 36 lakh 51,350 rupees. Sensex has delivered a 15.80 CAGR return, compounded annual growth return. That is year over year in the past 45 years. And your money has been grown to 736 times. And you can see it where the money grows. Now let's understand what is the market risk. If I am putting money in equity or security market, what will happen? Let's take a look. If I am putting money for 1 year, it has 45 observations, and the positive observation would be 31, and there are probability of positive return is 69% and negative return is 31%. That means in a year your money can lose its value. Similarly, in 3 years, total observation is 43, positive observation is 36, probability of positive return is 84%. That means probability of negative return is 16%, quite less. In 5 years, total observation is 41, positive observation is 38, and probability of positive return is 93%. The probability of negative return is only 7%, very less. And in 10 years, 36 observations have 35 observations are positive. That means 97% is probability you will get your money grow 97% and negative only 3%, very less likely. In 15 years, 31 observations have all the positive and you will get positive return 100%. And in 20 years, total 26 observations have also the similar result, that is 100%, and negative return will be 0. So how do you think on that? We have now two aspects, two major risks. One is inflation risk, another is market risk. Now think twice. If I am putting my money for longer term, then my money will degrow in inflation risk. If I am putting my money in the market risk, it may go down. But as such, how it will be? So conclusion is this. We have concluded on that inflation risk in shorter term is very low, but in longer term is very high. Whereas in the market, longer term market has a very low risk, and for the shorter term has high risk. So decide yourself from today onwards where you are putting your money to work for you. Are you putting money in a correct place so that you can beat the inflation, or you are losing money year over year? That is today for today's session. Thank you, those who have joined me, and whatever the data I have shown here is for the presentation purpose and total educational purpose only. This is not an investment advice or a recommendation to invest in particular finance product or service. All information contained within this presentation is based on publicly available data and is meant to enhance understanding of the subject matter. We do not guarantee the accuracy, completeness, or reliability of any information presented. So before taking any investment decision, please consult with your qualified financial advisor. By attending this session, you acknowledge and agree to adhere the guidelines. And mutual fund is subject to market risk. Read all scheme related documents carefully before investing. And I think so, maximum percent, those are not invested or those are newcomers, please do consult a qualified consultant or a qualified distributor so that you can put your money on lesser risk and a better way. It is always better, it is always advised to put your money with some expert guidance. That's all for today. Thank you. Bye bye. And have a look to like and share. Thank you. Jai Hind.